Is the SUD Lifestar TULIP plan truly a star performer in the ULIP space or just another product with glittering promises? Let us find out the answer to this question through an in-depth analysis. So hi, welcome back to Holistic Investment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. So now before analyzing this policy, let us first understand a few basic details about it. So this is a protection-oriented unit-linked life insurance plan. Some of the key features of the policy are you get to enjoy coverage up to 30 times your annualized premium under this policy, and you can make up to 12 switches per policy year without any charges. You can strengthen your plan with optional rider benefits. You get to choose between two strategies, self-managed or age-based, and you have the flexibility to opt for limited pay or regular pay, and you can also be eligible for tax advantages under the prevailing provisions of the Income Tax Act of 1961. And there are benefits like death benefit, maturity benefit, and return of mortality charges and wealth boosters. But as a unit-linked policy, there are also various charges that will be deducted from your premium, like premium allocation charge, policy administration charge, fund management charges, surrender charges, switching charges, partial withdrawal charges, and mortality charges. So all these charges act as an additional cost for the investor, because unlike most other equity-related investment options where such costs are absent, these charges can gradually erode your returns over the long-term period. So you need to consider this as a drawback. Some of the advantages here are partial withdrawals are allowed from the 6th policy year onwards. Settlement options available for death benefit. Policyholders can redirect premiums and switch between funds. Additional benefits credited every 5 years starting from the 20th policy year. At maturity, mortality charges are added back to the fund value. However, some disadvantages are investments are made only after deducting applicable charges. The sum assured may fall short of meeting adequate protection requirements, and the funds remain locked in for the first 5 policy years. Additional premium contributions are not permitted. Overall returns may be less attractive compared to other investment avenues. So these are some drawbacks that you need to keep in your mind before deciding to invest in this policy. Now, as we have a basic understanding about this policy, let us move on to the analysis part of the video, where we are going to conduct an IRR analysis. But if you do want to know certain aspects of the policy in detail, you can refer to the policy brochure. So now, as we have a basic idea, let us calculate the internal rate of return of this policy based on the policy brochure's benefit illustration to help us make a more informed decision. So for calculation purpose, let us assume that a 35-year-old male opts for this policy with a sum assured of 30 lakhs, an annual premium of 1 lakh, a policy term of 25 years, and a premium payment term of 7 years. So here we have depicted the future return assumptions at 4 and 8% per annum. These are not guaranteed returns, and they are not the only upper or lower limits you might get back. This is just to show you how this policy can perform at worst and best case scenarios for your easy reference. So the value of the policy will be dependent on a number of factors, including future investment performance. At 4% per annum, the return, the fund value is 9.68 lakhs. So the IRR would be 1.49% as per the maturity calculator. So even a basic savings bank account offers a higher return than this. At 8% per annum, the return, the fund value is equal to 22.91 lakhs, and the IRR is 5.51% as per the policy's maturity calculator. So bank fixed deposits currently yield better returns than this. So in both cases, the IRR is neither proportionate to the risk taken nor able to beat inflation. This means the real value of your money erodes over time. Instead of building wealth, investing in this policy could derail your long-term financial goals. So now, as we know that this policy is not giving us a desirable outcome that we need, which is inflation beating return, let us now explore an alternative scenario in the comparative analysis, where using the same premium used in the SUD policy, we are going to split it and invested in insurance and investments separately, just to see whether that can yield us better outcome in the long run compared to the SUD policy. So for a life cover purpose, we have opted for a pure term insurance policy with a sum assured of 25 lakhs, which costs us an annual premium of 20,500 rupees per year. So this leaves us with a balance of 79,500 rupees per year, which can be invested in line with your goals and risk profile. So here, let us assume it is invested in equity mutual fund for example purpose. After 25 years, the equity mutual fund pre-tax value is 69.08 lakhs. The post-tax value after capital gains tax is 61.29 lakhs with an IRR of 10.27%. If you have any doubts regarding how the tax is calculated for equity mutual fund, we do have a small tabular column presented on the screen for your easy reference, which you can pause and see. So the term insurance plus mutual fund combination not only provides you with adequate life cover but also generates inflation beating returns. So in contrast, the SUD policy delivers lower returns, making it inefficient for long-term wealth creation. By opting for the split strategy, you achieve faster wealth accumulation without compromising on protection. So what is the final verdict then? Is investing in the SUD Lifestyle TULIP plan worth it or not? So this is a market linked insurance plan that combines life cover with investment. So while you pay premiums either for a limited period or throughout the policy term and receive the fund value at maturity, the returns are not proportionate to the risk involved, and it also has a high agent commission. So why are the returns so low? Premiums are invested only after deducting multiple charges which eat into your growth. And unlike many ULIPs that provide life cover of up to 10 times the annualized premium, this plan offers a much higher cover of 30 times. While it seems attractive, it significantly raises cost and reduces the investable surplus, thereby dragging down potential return. The combination of higher charges, low returns, and disproportionate risk makes this policy unsuitable for wealth creation. So sticking with it could derail your long-term financial goals. Alternatively, for life protection, you can opt for a pure term insurance policy, the most cost-effective way to ensure adequate cover. For investment, you can channel your savings into products that deliver better inflation-beating returns aligned with your risk appetite.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.